Welcome to Hugh's Market Minute. I'm happy to have you back and happy to bring you up to date on what I think is going on in the financial markets and the economy. Maybe I'll touch upon the political environment, which is becoming a bigger factor in our thinking, everybody's thinking about the financial markets and where they're headed. First of all, the financial markets in many ways have performed better than we'd anticipated. The market had been overvalued or somewhat overvalued. The last time we talked, we had put it at being about 5% overvalued, and we thought that the upside was fairly limited. I mentioned at the time that the upside was limited unless we had a number of things happen. Ongoing liquidity from other parts of the world coming into our markets. It's perceived by other parts of the world, particularly given some of the economic problems that exist in Europe, as well as the United Kingdom, as well as some of the economic problems that exist in many emerging market economies. It was perceived that the U.S. economy, the U.S. stock market was the only game in town, so to speak. And so we've seen a lot of foreign liquidity come into our markets and drive it beyond levels that we thought were a little bit pricey or overvalued. That was reflected, of course, in the strength in the dollar. The second thing, which I think is much more important, is that you can become overvalued in the stock market, and it can become even increasingly overvalued as it becomes somewhat speculative. Having periods of significant speculation characterized by the emotion of euphoria in the markets is not at all unusual. And that looks like what we're having. We have, not only is the market overvalued, but we have fairly strong upside volume. And of course, one of the things that I look for, and I ask myself the question, is it a period of speculation, is I look for signs of widespread optimism. We don't see widespread optimism yet, so if I were to say anything, it would be that we may be seeing some speculation, but it's the early stages of speculation, which simply says that the market's a little bit pricey, a little bit overvalued, but the speculation can carry us even a little bit higher. The most important question which faces every investor and faces us as we're working on your portfolios is, are we seeing those signs from the financial markets, signs from the economy that say to us that we're at the end of this so-called bull market, economic recovery, interest rate cycle? And the answer to that question, again, based importantly on the performance of the financial markets and the performance of important economic variables, monetary and economic variables, is no. Even though this has been a very long bull market, economic cycle, interest rate cycle, even though it's been very long compared to many others in the post-war period, we still don't see those hard and fast signs that the economy, that things are going to come to an end or the cycle is going to come to an end, and we need to become defensive in portfolio. Probably the most important sign we pay attention to is the index of leading economic indicators published by the Conference Board. That index continues to improve. It's generally been rising. It's not rising as rapidly as we saw maybe a year ago, but it's still doing just fine and telling us that the economy is likely to continue to expand through the remainder of 2016 and 2017. We've reduced or revised downward a lot of our numbers, our expectations for the results for the U.S. economy for 2016 and 2017. We've revised our outlook for earnings, which look even a little bit better. We revised a lot of numbers, and basically they say we've got further to go in the current cycle. The bull market is alive and well. The economic recovery is alive and well, although things are not going to be quite as robust as we had been looking at or seeing, experiencing up before. So the point being is that we've got a little bit of an over-allocation beyond the targets of clients, a little bit of an over-allocation to equities. I think the return on equities is not going to be great, but the return on equities is going to be greater than the return on fixed income, and as a result, that's why we're a little bit overweighted in equities. Everybody should be pretty happy about the current state of affairs. Market performance has been fairly good, maybe even a little bit better than we'd been expecting. That's all good news, and it looks like there's probably more good news ahead. Despite the fact that we're very positive, despite the fact that we're encouraged by the market signals as well as the economic signals that we see, That doesn't mean we've let our guard down. We're not going to let our guard down. We're going to be on our toes, particularly given the length of this this bull market and economic recovery. We're going to be on our toes looking for those signs that tell us that this current cycle is extended, has gone too far, and is about to end. We don't see them, as I mentioned before. We don't see those signs right now, but we're certainly going to be watching for them. And if we do see them, we're going to start to shift portfolios towards the defense. So this is really just an update. It's a good update. It's a positive update, but at the same time, just my nature and our nature to be very guarded, particularly when you have a bull market that's been as long as this one, an economic recovery as long as this one. Thanks very much for joining us. And if you have any questions, please feel free, give me a call. Give anybody here at Hugh Johnson Advisors a call, and I'll be back with you hopefully in the next couple of weeks to give you a further update on the current state of the markets and current state of the economy. Again, thanks for the confidence you've shown in us.